Yeah, coming to you live from northern Israel. It's Monday. Holy cow, it's Monday. 22nd, 23rd, whatever it is. 23rd of December. Sheesh. 2024. We only have another 8 days left of this year. Wow. Yes, I know. I can count to me. Means we're coming up on the Christmas holiday, on the Hanukkah holiday, on did Kwanzaa happen yet? Sorry, folks. I don't remember my Kwanzaa calendar. But there's a bunch of holidays coming up. There's New Year's coming up. And then we'll be in 2025. And meanwhile, everyone's favorite orange crypto coin does not stop. Nor does the silver coin. What's the silver coin? Litecoin. And what is happening with orange coin and with silver coin? What is the situation? Well, at the moment, if you love Bitcoin at 108K, you're going to love it at 96. Why do I say that? Well, hey, if you wanted to buy it when it was in the 60s and you didn't, sorry. Could it ever go there again? Yeah, it could. Does it mean it has to? No, it doesn't mean it has to. But could it? Yeah, sure, it could. Now, pattern hunters will always tell you what you'll see price never dips below the low of the last cycle or whatever nonsense. They'll point to some silly pattern. And the top of the last cycle is the low of the next one. Okay. We don't trade like that. Right? If you're a smart money trader, you know the only thing that matters. Like if you're investing, you buy and hold and you forget about it. Okay. If you're an actual trader, intraday trading, what matters is low time frame trades using volatility, entropy, probabilities, and statistics. Why? Because those are the relevant maths that actually tell you where the asset is likely to go. Right? That's where you get the highest probability of being consistently profitable because you're consistently on the winning side of the trade more than any other method that is known. Why? Because the systems that run the markets are big, huge computer-based algorithms programmed by people. So very logical devices programmed by very illogical biological beings and managed by people. So they use non-emotional methods, right? The bots that are software, they don't have emotional chips in them. They don't use irrational decision thinking. They just run the programs. They run the trades according to what the irrational programmers built into them. That's all. And what the irrational managers tweaked about them for the specific day of orders, telling them, we want to trade this basket of things or this basket of things, or we want to change the standard deviation throttle from 1 to 1.5 or 2 or whatever it might be, 2.96, right? And we want to use the normal distribution model now instead of the low cost, or we want to use both, or whatever it might be. Why do they do these things? Well, because when you have massive bags of capital and you're looking for long-term capital preservation and growth, you want to make sure that as a firm running these huge amounts of trades, and we're talking millions of trades per second, right, that last on average 0.2 seconds each, you want to make sure that your trade goes your way most of the time. So you're providing liquidity to the market. You get in and out extremely fast with huge positions relative to the average retail trader, but they're tiny positions for the firm. right? Like $1 million order might seem like a lot to an average person. Even a $10 million or $100 million order might seem like a lot for an average person, but is nothing if you have trillions of dollars under capital management. And there are firms that do, like BlackRock, right? So, what does that mean? Well, that means that that is the reason that the assets run the way they do, because these firms use these algorithms. Why? Because they're very precise. They're very good at winning trades. They're very good at moving the market the way they want. Now, why do they not run trades that last longer than 0.2 seconds on average? Well, because they run millions of trades per second in order to nab little tiny wins, right? Lots of them. That's how they do it. Because they have very fast computers, very fast information speed, very fast connectivity to the markets. So it is mathematically less risky for them to be in a trade less time. Also, they don't pay maker fees or taker fees. They pay nothing for the trades because they already pay for order flow information. They already pay for direct connectivity to the market servers. Like literally their computers' cables, right, from their company, which are stored in some rack in New York somewhere. For example, if you want to connect to the New York markets, their computer cables are literally physically plugged into the ports of the New York market servers, right? The Dow Jones or whatever's running the NASDAQ, it's literally plugged into their servers right there, and also plenty of crypto exchanges have servers right there, and they physically plug into those servers. And if you think the big Wall Street companies are not trading Bitcoin, well, obviously they are, since they're literally buying the underlying for their ETFs, and they're obviously selling ETFs to customers who want to sell ETFs, and they're buying each other's ETFs. Yeah, and many of the issuers are buying their own ETFs. They're literally, as they say, getting high on their own supply. Okay. So when they buy their own ETF, what does that mean? Well, it means you got to buy the underlying in addition to buying their own ETF of the underlying. Now, why would they do that? Well, it's a kind of double insurance policy, right? If the value of the ETF goes up, that's also because the value of the underlying goes up, in which case they've doubled their profit. And if it goes down, yeah, they double their loss. And they do it without taking leverage. And at the same time, they're holding the underlying asset, right? Which means they don't have to sell it. Because to them, even at $100,000, it's cheap. And I've been telling you this guy for months, right? When it was like, 30, 40, 50, 60K, I was telling you guys earlier this year, even I was saying, guys, back in like January through June, when the big 9 ETF companies were buying all of these, more than 1 million Bitcoins off the market, and now they have about 1.5 million of them they bought this year. The big firms, the big whales, right? What have they been doing this for? Because they view Bitcoin as a low-risk investment asset right now. That's right, low risk at 100 grand. They view it as low risk. Why? Because they believe it's going to go to many millions of dollars. Because mathematically, that's what it seems like it's going to do, in their opinion. Why? Because there's a limited amount of them, right? It's been yielding good returns for the past 16 years. There's a greater demand than there is a supply. perceived to have value because of all of its qualities. It has inherent qualities like it's immutable, it's portable, divisible, scalable, mobile, pseudonymous, or even anonymous if you know how to do it correctly. It has a lot of benefits, right? But the fact that it's uncensorable and portable makes it very valuable in people's minds. And the fact that it's scarce makes it even more valuable in people's minds. Because the fact that it's scarce means there's a limited supply of it. And the fact that there's a limited supply of it means there can only be so much of it in the world. And the fact that there is only a limited supply of it in the world, and that more than 95% of it is already owned by whales that have 100 or more Bitcoins in their wallet. Right, more than 91% is owned by whales that have 1,000 or more Bitcoins in their wallet. It means it's never going to be dominated by retail holders again. It was once upon a time, sure. When we started Bitcoin mining in the very beginning of 2009, it was only retail that held any Bitcoins. As the years went by, smart money got into the space, eventually bought more and more, and eventually owned more than half. Once they owned more than 51%, they brute forced it. They didn't change the blockchain, but they brute forced ownership. They began buying it at insane rates and at prices that the average person could never afford. And that's exactly what happened. That's exactly how you got to a situation that we're in now, where the average person cannot afford a Bitcoin, will never be able to afford a Bitcoin, will never even be able to afford 0.1 Bitcoin. Which is why people like me have been saying for years and years and years, if you have any of this stuff and you don't have to sell it, don't sell it. But yes, if you're trading it, of course you buy, you sell, you buy, you sell. But at the end of the day, you want to stack Satoshis. You want to end up your day with more Satoshis than you started if you're an active trader. And if your life is relatively in order and if you're not subject to insane things, that are causing you to not be able to stack money over time. And by the way, that happens. It's a perfectly understandable situation. I've had that situation a long time in my life, where it doesn't matter how hard I worked, doesn't matter how much I earned, I wasn't spending wildly on some crazy lifestyle, ever. Okay? But I had expenses that were significant, that were not reducible, that were not optional. For example, healthcare related, that I had to take care of. Mostly for my loved ones. And so it doesn't matter how much you earn. You earn, $1 million a year, you're still going to be losing money, whatever. It happens all the time to lots of people for different reasons, not just healthcare. It could be anything. It's not always frivolous spend. That's the thing I hate about these videos that talk about finance. They always tell you, you just have to get your shit together and save and invest in this and that. Yeah, listen, man. There's a lot of people who cannot do that. Right? They might be unemployed, they might be underemployed, they might not be earning enough because of expenses in their life. You don't know. You don't know. And it's disgusting to assume it and to be critical of people who don't have the ability or who don't put away for the future. You shouldn't be critical of anybody in their financial situation, unless you actually know that there's some reason to criticize them for it, which means you personally know them deeply and you have reason and ability to properly and wisely criticize for their own benefit, like constructive criticism that helps them actually move along, like advice that actually is useful to them specifically. You can't give general advice. It's not possible. Okay. Because if I say something like, oh, just put $5 a week away, it might sound crazy, but there are many people who literally cannot do that. Okay? They are to the penny, they know what they're going to spend this week. And when prices go up on them, it hurts. When prices not of the Bitcoin, when price of milk goes up, when price of bread goes up, when price of butter goes up, when the price of, jam or whatever they eat, peanut butter, apples, right, bananas, whatever, it hurts them. Well, that's one less banana this week, one less apple, half a loaf of bread less, and one sandwich less per day, whatever it might be. There are people who know these things because they don't earn enough. They don't get enough from Social Security or unemployment or both. Right? So I'm just saying. That's why I don't give financial advice. Because you don't know what other people are going through. All I can say is if you can afford, then in my opinion, it's worth doing your research about Bitcoin and Litecoin. And there's some other ones too, but those are the main ones in my opinion. Anyway, doesn't matter what I think. I hope you all have a great day. I hope you're able to stack sats or lights, which are the Litecoin equivalent of